Hello, welcome to this company presentation for Heimstaden AB. My name is Christian Fladland and I'm co-CEO of the company. This presentation is made in conjunction with an announced tender offer and a potential subsequent new issuance in relation to a liability management exercise whereby we will extend our maturity profile. Heimstaden AB is an investment company with an associated management platform. The most mature investment in the company is our shareholding in Heimstaden New, where we own 36% of the equity and just more than 50% of the votes. The gross value of this was 46.1 billion SEK as of Q1 25. In addition to the holdings in Heimstaden New, we have 3 direct property holdings, a public use property in Heimstaden comprising a school, an office building in Malmö with potential for student housing conversion and new build residential development on the site, and a new development in Copenhagen where we just initiated construction earlier this year and with an expected completion by Q1/Q2 2027. The management platform relates to the overall management agreement to the Heimstaden New property platform. It is valid until 2047 and it is supported by 130 FTEs, which is working dedicated on managing the whole strategy of the platform, including investment, optimizing funding structure, capital raising, asset management, and operational excellence. The income streams from the management agreement amounts to 0.2% of GAV and is invoiced on a quarterly basis, approximately 650 million SEK as of 2025. From the shareholdings, we are getting a senior dividend from an A-share, which also comprised to 0.2% of GAV, which accrues on an annual basis, and it has comprised approximately 1.7 billion SEK by the end of Q2 25. In addition to that, there is a principle that we should distribute all profits the company has made related to the different share classes and the waterfall associated with it, of course, subject to us being in compliance with our financial policy. If we move on and look at our portfolio in Heimstaden New, we are diversified across 9 markets, which is fairly unique for a residential platform. We have more than 160,000 units comprising an asset value of 323 billion SEK as of Q1 25. We seek to have critical scale in all the markets where we are present. We want to be vertically integrated in order to own the whole value chain. And that is something that we have built up over the last 30 years investing in residential real estate. There are 3 markets that comprise a fairly moderate part of our balance sheet, only around 3%, and that is the UK, Poland, and Finland, which is markets that we have only started to growing in after 2021. If we look at the operational performance of Heimstaden New, we have continued to see record performance over a subsequent number of quarters. On an occupancy basis, we have been trending above 98% consistently all the way back from 2021. And then we look at a more clean trend basis, we actually see that we reached 99% in Q1 25 if we adjust for one larger new build delivery that was taken on in December of 2024. So from an occupancy perspective, we feel highly confident that as we stabilize this asset, we will set new record highs over the course of 2025. Combined with the high occupancy rates, we've also been able to continue to drive very strong rental growth, which in Q1 25 amounted to 5.4% on a like-for-like basis. If we look backwards, we see that we have now been exceeding the underlying inflation trend by a significant margin since Q4 23. And the shortfall that we saw in rental growth versus the CPI development during the high inflationary period in the second half of 2022 and first half of 2023 has now been fully recovered. We believe that we will continue to be able to drive our rental growth well above inflation going forward, which I will return to on the next slide. Looking at the cost side, we have been able to manage our OPEX side very well in a period where there has been inflationary pressure, in particular on the utility side. If you look at it on an absolute basis, we've actually been able to reduce OPEX spends in recent years, thereby utilizing the synergies that were realizable after the significant growth that we experienced until 2022. When we combine the strong cost control with very strong revenue growth and top line growth, we've also been able to drive a significant increase in our NOI margin, which hit 71% by Q1 25 on a last 12-month basis. Our guidance for the whole year was 70 to 71%. And even though we have reached the 71%, we have not been out revising our guidance. But we have, after our Q1 report, signaled that there is a decent likelihood that we will be able to outperform that moving further into the year. Moving to the next slides and looking at how valuations have developed. We have, after 6 quarters of negative value growth from the mid of 2022 until end of 2023, now had 5 quarters of positive value development across our portfolio. There has, in particular, going into 2025, become a more homogeneous development where we have seen positive value growth in all of our 9 markets for the first quarter since early 2022. It's also important to realize that this value recovery has been a period where we have actually continued to see moderate yield expansion. And if we look at the yield expansion that has materialized since the beginning of 2022, there has been a significant offsetting factor from the underlying NOI growth. This reflects that there has been a significant rent potential built up in the portfolios. And even though that yields were set to expand further from here, we believe that value growth will continue to be positive. It's also important to realize that the valuation yields quoted are what is reflecting the direct NOI yield. And that also means that if you have an asset in Berlin, for example, where it's leased out at €6 per square meter, but there is a market potential to go to €18 per square meter, it will be a NOI based on the €6 per square meter. So there's a significant underlying growth potential already inherent in this valuation yield of 3.7%. And if we were to evaluate the valuation yield on a stabilized basis where we have utilized the underlying rent reversion in the portfolio, we would see this trending above 4.5%. Moving to the next slide and taking a very high level deep dive into the underlying trends driving residential, the supply-demand dynamics. We have seen a significant household growth across all of EU and in particular in the markets that we have been present in the past decades. But then when we look going forward, we continue to see that there is a significant household formation going on, where it's on a trend basis across the EU amounts to around 0.3% per annum. And the markets where we are present and in the regions in particular, we see that trend at around 0.5%. So even though there has been a lot of considerations around decreasing fertility rates, population growth slowing down, there is still significant regional differences related to urbanization trends, but also socioeconomic trends, which shows that there is an increasing number of single households, increasing the number of households significantly more than the underlying population. When we lay over this demand forecast with the supply outlook, it shows that there will be an even bigger mismatch than we have seen in the recent decade. Since 2021, we have seen a reduction in new housing permits across our markets of around 50%. If we go back to the financial crisis, you would have seen that come down by around 42% from 2006, 2007 until 2009. So the drop we have seen in recent years has become much more severe. And the reason behind this is that combined with the construction cost inflation, we also saw the increased interest rates. So if you combine that, it becomes more expensive to make new builds and you also increase the cost of capital, then the rents that needs to be factored in order to make new development viable has skyrocketed. So in general, we see across our markets that rents would have to increase around 40 to 50% before new builds are viable in larger scale again. And that's also one of the reasons why we are so convinced that we will continue to see rental growth well above inflation in the years ahead. Even though that the underlying rent indexations from inflation will be lower, we believe that when we are reletting units, when tenants are vacating and there is natural tenant fluctuation, we will continue to capitalize on an increasing rent reversion. This is also being factored in by institutions where we see that more and more are allocating more to residential. Real estate has historically been dominated in institutional portfolios within offices or larger shopping centers. But as there has come an increased uncertainty about the outlook for these sectors, and in order to also diversify yourself into something that is less cyclical and more structural driven, we have seen residential coming to play a more and more important role in institutional portfolios. When we look at INREV surveys among European institutional investors, we saw that residential amounted for around 17% of their portfolios back in 2018, where you had offices being the largest sector together with retail. Moving forward until the end of 2024, we saw residential allocations had increased to almost a quarter. And if you look at how they're assuming to deploy their upcoming investments, they also see that they will favor residential at the expense of some of the more traditional sectors, with also sheds and industrial logistics taking an increased share. So with this increased demand, we also believe that there will be increased competition, putting a downward pressure on stabilized yield requirements. Zooming in on our privatization program and what we have done both in order to recover our rating and support the deleveraging while also creating shareholder value. This is the program that was launched back in Q3 23, where we started divesting individual units when tenants was vacating across a number of our markets. What we guided initially was that we were to sell 20 billion SEK of units by the end of 2025. We guided that we would anticipate a gross premium, i.e. premium to book value, of around 20%. To date, we have been fully on track in order to reach the 20 billion, and that is still our guidance for the end of 2025. To date, we are slightly ahead of our guided premium. We have actually realized 26.4%. And we believe that we will continue to trend well above the 20%, albeit we do believe that it will come down from the 26%, probably closer to 23 to 24%, when we continue to scale up in Norway in particular. Net premiums is almost 15%, and net premiums reflect that we crystallize quite a lot of capital gains tax when we are selling these units. But this is measured on a gross asset value basis. So if you look at the equity accretion from this, if you have 50% LTV, it's almost a 30% return on equity you make from these disposals. Combined with this, we are freeing up significant liquidity. There are typically asset-backed funding related to these units that we repay when we sell them. And then we have the net liquidity that we can use for deleveraging purposes in order to support our ICR. Looking at the underlying trend in our privatization markets, it is evident that the house price development has been very favorable, and it was only very temporarily hit by negative value development over the course of uncertainty in 2023. Moving into 2024, the supply-demand imbalances continued to kick in and dominate. And also, it's important to realize that all of these markets has quite tight credit regulation. So even though that you had interest rate trending around 0% for a decade, you didn't have any borrowers who was actually approved for lending on that basis. In general, there has been requirements on given equity ratios. There has been caps on how many times your disposable income could be leveraged. And that also shows a much bigger resilience now, because even though all households or these homeowners prefer lower interest rate, it hasn't been a restricting factor in order to keep high liquidity and also keeping prices growing at a pace that is probably will continue to trend up as we see there is no new supply coming to the market. So how does this performance in Heimstaden Bostad spill over to Heimstaden AB? So Heimstaden AB has a significant shareholding, as mentioned initially, of 36% of the equity in Heimstaden Bostad, amounting to around 46 billion per Q1 25. But we also have a share combination whereby we, together with our institutional partners, have made a split in the upside-downside split by having a preference share class, which the institution have the majority of. And then there is a common share class, which is junior to the pref share class, which Heimstaden AB has the majority of. So that means when you see values decline and there is negative return on equity, Heimstaden AB takes the biggest hit, as you will see from this graph from Q2 2022 until Q4 23. There was a significant reduction in the value of our Heimstaden Bostad shareholding. But since Q4 23 until Q1 25, we've actually seen a fairly steep recovery. And if we eliminate the most recent FX impact in Q1 25, where we saw that the SEK krona was significantly strengthening, you would actually have seen almost 25% increase on a like-for-like basis over just a 5-quarter period. So when we look ahead and we continue to see strong operational performance, NOI growth will continue to drive value growth. And we also believe that there will be more fierce competition among institutions for residential investment product and home ownership markets that is continuing to benefit from the supply and demand imbalance. We believe that we are only in the very early stage of a continued value appreciation within residential real estate, which in particular Heimstaden AB will benefit from due to the share combination we have. If we take a bit more deep dive into the different share classes and also the sources of liquidity for Heimstaden AB, there is the management fee that I referred to, which is invoiced on a quarterly basis. That is, of course, the most senior income stream, as that is paid as all other OPEX from the PropCo. Looking at the dividends from Heimstaden Bostad, we have the three economic share classes, the A-share dividends referred to of 5 basis points per quarter, which is accrued on an annual basis. We didn't do any distributions in 2024 and 2025. And for that reason, there has now accrued this 1.7 billion SEK of A-share dividend. So as soon as dividends are to be reinstated in Heimstaden Bostad, the A shares are the ones that will receive it first before any of the other share classes will receive. The B share dividend is based on the underlying LTV in the company. So if there is a higher LTV, they accrue a slightly higher dividend, and it's linear between 3.5% to 4.5%, depending on the LTV in the interval 40 to 65%. On top of that, there is also a kicker whereby you get a slightly higher return when it's performing above 5% ROE in the vehicle. The dividends can both be paid out in cash, but it can also be paid in kind through the issuance of new B shares through a rebalancing mechanism, which is intended to keep the ratio between B shares and common shares fixed. The common shares is the residual part of the capital structure, which is then entitled to all remaining dividends after A and B share has been satisfied. And this is what we have a dividend policy around, that all profits should be paid out in principle. But the most recent year's development, in particular from 2023, where we had significant value losses, is something that has been paused in order to make sure that we can stabilize our rating in Heimstaden Bostad and eventually also recover the BBB flat rating, which we feel comfortable we'll be able to do, at least qualify for by the end of 2026. If we look at both the historical cash flow generation from Heimstaden Bostad and also how we see it going forward, there has in general been a cash dividend yield on the shareholding of Heimstaden AB in Bostad of just around 5%. And we believe that that will also be the level going forward. And we also believe that when reinstated, that it will be somewhat higher, given that the A-share dividends are accruing and we will get that catch-up. We still have a firm belief that dividends are set to be reinstated by 2027. When we look at the performance of Heimstaden Bostad and the deleveraging path we have there, we believe that reinstating dividends in 2027 is feasible, both from credit metrics that needs to fulfill a BBB flat rating and also from an underlying organic liquidity perspective in Heimstaden Bostad, where we see that the funding has become much more flexible. Looking at the other assets, it doesn't comprise a big part of the Heimstaden AB balance sheet, but both the office building with the development potential for student housing and new build on a parking lot on the side, as well as the school, is something that we expect to sell within the next 12 to 18 months. And that will also reduce the associated asset back financing related to those of 276 million SEK, and of course release the equity associated with such. Looking at the maturity schedule, after we did our refinancing in January 25 of our 25 and 26 maturities, the first upcoming capital market maturity is the March 2027 bond. And that is also the bond that we want to address with this announced tender offer and the intended refinancing of such. We still have a very good maturity headroom. We still feel that we have good runway, but we also believe that it is important to continue to have a prudent liability management profile. And we also reckon that it will create more flexibility in order to make sure that we can be more flexible in order to do what we believe is the right thing to optimize the value within Heimstaden Bostad. So the intention behind this exercise would be to have the 2027 maturity extended until the end of 2030 or early 2031. Given that we are targeting our 5.5-year maturity. We also want to make sure that we have the flexibility to repay it earlier through a call structure, as the underlying ambition is still to continue to deleverage Heimstaden AB. We also have the hybrid instruments that we have paused the coupons on, both the SEK and the Euro hybrid. And by extending the maturity of the 2027 bond, we also see that we will have increased flexibility for reinstating those as we can see that dividends are reinstated from Heimstaden Bostad to Heimstaden AB as well. So if we are to summarize where we see ourselves as of now, and we believe that we have a very good position within our asset class that is set to continue to improve from here. It is also not only combined with an attractive asset exposure, but also a management platform, which is very capital efficient for us and is providing high margins, and where we'll consistently see growing management income that will be linked to the underlying value development of the portfolio. We also see that the privatization program has proven itself not only in order to support the deleveraging, freeing up liquidity for the rating recovery, but also has been able to do that in a very accretive manner for the shareholders, which also is benefiting Heimstaden AB in particular through the share combination. The forward-looking NAV growth is something that we believe will continue to develop very favorably, even though 2024 was only a year of fairly stable recovery with value growth of 2.7%. We still saw that the underlying NAV of Heimstaden AB increased by 15%. And looking at the underlying trends across all our markets today, we believe that that is only set to gain further momentum in 2025 and going into 2026. And thereby, we would be able to reinstate dividends in Heimstaden Bostad by 2027. By doing that, we also believe that we will be able to both balance our commitment to deleveraging, either through calling any of our extended maturities before time, or doing something more proactively on the hybrid stack as well. So this liability management exercise is something that we are targeting in order to create a more flexible maturity profile. It's not an ambition to continue to maintain the same amount of debt longer term, but we believe that it's important to balance this risk management and liability management with our ambition to deleverage, and also consider how we can create increased flexibility in order to address our hybrids, where we definitely see that there is an interest from our end and to reinstate the coupons there as soon as we believe that that is prudent to do. On that basis, I will close down for this company presentation. I would like to encourage everybody who has have any follow-up questions to reach out. And we are available for doing one-on-ones all over the week, and also for doing any bilateral clarification via email through our investor relations. Thank you, everybody.